Hey everyone, it's the start of the year, and actually we're more than halfway through the month of January, which means that I'm a little late getting this out this year, but I had a lot to catch up on. Successfully spent a good 2 weeks with my family, with my wife and kids, and for the first time in probably 9 years, I only checked a little bit of email each day, worked on a couple, crucial activities when they came up, but for the most part, went metaphorically off the grid during the holidays. So this year so far has been a bunch of catch up, planning for 2024, and one of those tasks was obviously putting together this report as we do each and every year. And so what we're going to be talking about today, to jump into the agenda, is first and foremost where the market stands today. Then we'll change gears and talk a little bit about the U.S. stock market. We'll talk a little bit about international stocks. There's not a whole lot to say, and I'll explain why in a minute. We'll go over bonds, fixed income instruments. Again, and there's also not a ton to say about that, the bond market either, but I will talk a little bit about that and show you a couple charts. We'll talk about some alternatives, so things like gold, oil, Bitcoin, and probably the bulk of the material here is going to be in the U.S. stock market. There's a lot to talk about when it comes to U.S. stocks, as well as intermarket analysis, a bunch of indicators, and then closing out and looking ahead into 2024. So as I always start with a quote, I'm actually going to end with one today too, so just teasing you here. The quote goes, "The market may be crazy, but that doesn't make you a psychiatrist." So the market has been crazy, and not just this past years. A little bit of volatility, kind of a little pullback to begin the year, correction about 2/3 of the way through the year. But anyway, I just thought it was a funny quote, so I thought I'd share. So let's start with where the market stands today. And the first thing I want to share is talking about the volatility and the drawdowns. And when you look at the most recent drawdown, and this was a chart pulled up by Charlie Bolello earlier in, it looks like November 7th, so it was a pretty old chart at this point. And this number, instead of saying 1.8 years up top there, it would say 2 years at this juncture. But this was the third longest drawdown going all the way back to 1990. So the only longer drawdowns that we saw would have been the mortgage crisis and the dot-com bubble. So it was pretty nasty in terms of length anyway. I wouldn't say the depth was nearly as bad. You can see there that in the dot-com bubble went down a whole lot more, as did the mortgage crisis during the Great Recession, as it was called. But this was still a very long bear market, and we finally reached the end of it in terms of time. I wouldn't say the same for price, by the way, but I did think that this was a really interesting table. Changing gears here in terms of drawdowns again, this one's even more important. We're looking at bonds, and when you look at the longest drawdowns going all the way back to 1976, it's a long time ago here. You can see here that the current drawdown in the bond market has been the longest. And currently, if you just look at the AGG, which is the aggregate bond index, when you look at pretty much all bond sectors averaged together, then we're looking at a drawdown currently of about 17.2% in terms of depth. But as far as length goes, we're working on almost year and a half now. I'm sorry, 3.5 years that this bond market's been going down, and it's not. It's starting to show signs that maybe it could be close to a bottom, but at the same time, we have to ask ourselves, when it comes to bonds, we always have to remember that interest rates and bonds are inversely related. So when interest rates go up, bonds go down, and when interest rates go down, bonds go up. So when the Fed finally does decide to cut rates, that could be a good sign that maybe we'll get some wind at our backs in the bond market. But until then, it's probably going to be pretty choppy, and I think you got to be still very, very careful in the bond market. Not to beat a dead horse, I know I've said this in prior articles, videos, screencasts just like this one. For the last 2 years at this point, I've been saying that you cannot look at bonds as a safe investment anymore. You can't look at it and assume that when the stock market goes down, that the bond market's going to help you cushion that blow. It's just not the same anymore. We're at the end of a 30 to 35 year bull market in bonds, and all of that was, well, not all of it, but a good majority of it was a result of the declining rate environment that we've been in since the early 80s, late 70s, early 80s. One more thing, speaking of drawdowns. One of my favorite analysts in the world. I have a lot of mentors that I've taken on over the years, but Greg Morris, he's a technical analyst, former portfolio manager, author of at least 3 books, I think 4. I know I've read 2 of them, but one of the things he said a few years ago in one of his articles, and it was probably more than a few years ago at this point now that I think about it, but since 1885, the article that he was writing at the time said since 1885, the stock market had been in a state of drawdown more than 96% of the time. Now, I know it probably sounds crazy, but think about it. When the market can't make all-time highs every day, and so whenever it makes an all-time high and it pulls back, the drawdown begins. So the market is usually in a state of drawdown. The question is, how long is the drawdown and how deep is the drawdown going to be? And there's levels, right? It's almost like my inverse stoplight or my inverse traffic light chart that I do. Just because the market's at a high doesn't mean you shouldn't buy. All-time highs are good. I mean, that's about as bullish as you get. If the market's at all-time highs, that's a good thing. It's very bullish for the market. Whereas I think human nature makes some of us think that, well, the market's at all-time highs, I'm paying really high prices, so I don't want to invest my money. I want to wait until things get till I get a sale. And then what happens is the market goes down, and of course people worry because it's down, it's going to keep going down. So they say, well, I'm going to wait for things to get better first, which translates into I'm going to wait for prices to get higher, right? So I think that's where it's really important to have a guide, a coach, if you will, on your side, an Obi-Wan Kenobi, so to speak. And I think that's why here at our office we always joke that's why we have a job. Obviously there's people out there. We always say, you don't need us. There's people out there that can manage their own money. They don't need financial advisors. But I would say it's a relative minority. And that's because you have to be extremely disciplined, almost robotic when it comes to your money. And the money's a very emotional thing. And so anyway, I just thought it was interesting to pull this up. I just pulled a new chart up. This is literally as of the market close Friday, the 19th. So pretty interesting chart there. Okay, let's change gears, talking about stocks. So let's start with the U.S. stock market. Very heavily or handedly above the 200-day moving average here in blue. This is what I would call underwater. If the market's underwater, we can only stay underwater for a certain amount of time before eventually we run out of air, and then the market starts to die on us. So you can go back to the beginning of this most recent market crash. You can see it went below water for a few days, popped back above it, back below water for a few weeks, popped back above it for air, and then it was over. Even when it tried to get back above water here, it just sank right back down and created new lows. And then when the market started to recover in early 2023, so early last year, popped above water for just a day or two, back below it, then got some air for a good period of time in January, February, went back below water just for a few days and was back off and off to the races. As I mentioned when we first started, there was not only the pullback that occurred between late February, early March, but there was also a market correction that took place from end of July through the end of October, and that was kind of a pretty nasty correction that had people fearful. But we're right now, we're sitting at all-time highs for the first time in a long time. The drawdown period, like I mentioned earlier, is over with, at least for now. I'm sure we'll start a new drawdown period soon. But this 200-day moving average, you can see here the distance between that 200-day moving average and the price of the market today is pretty big. I can't remember who coined the phrase, but I know I stole it from somebody, and then I think I lent it over to Joe Fahmy, but we call this daylight. So the distance between the moving average and the price is, there's a lot of daylight there. And what that usually means is not only does it mean that things have been good, but it also means that it wouldn't be abnormal to see a pullback or a correction, or at least for the market to chop sideways and digest the most recent gains as the moving average kind of catches up. In other words, price can't go parabolically higher forever, right? The market breathes in and it breathes out as well. So to see the market pull back here in the next month or two would be completely normal, expected, and okay as far as I'm concerned. Well, another look at the market here is the S&P 500 with the 13 over 34 week moving average. The red line right here is the 34-week moving average. It's the 34-week trend line. Basically, it smooths out the S&P 500 over 34 weeks. And then the blue line is the 13-week moving average. So it smooths it out over 13 weeks, which means because it's shorter, it's a little faster. And when the 13-week crosses below the 34-week, that's usually considered to be, in my opinion, a down market. So you can see this red area here is a bear market, or in other words, a downtrend. And you can see here it crossed back above it right there just for a couple weeks, 3 weeks to be exact, was back below it for 3 more weeks, and then back above it again toward the end of March, beginning of April, and we were off to the races. You can see here during that correction that took place between July and the end of October, that the 13-week tried to get below the 34, but wasn't able to do so. And as you can see here, we're not only seeing price rise higher, but we're seeing the distance between the two moving averages expand, which obviously makes total sense given the nature of the market right now. Want to look at a few things. Anchored VWAPs, volume weighted average price. This is something that Brian Shannon, my good friend and swing trader, a very successful swing trader, I might add, at alphatrends.net, for people who are looking for advice and help on how to learn how to trade short term. So we're talking holding periods of 1 to 3 weeks. That's not me. That's not what we do here for our clients. But like I said, Brian Shannon is very good at this, and he coined the anchored VWAP. And that what it does is it looks at the average price paid by market participants since the anchor. And then what I did here was I anchored the VWAP from the market high, and I anchored it from the market low. And what I found really interesting here, I know I was showing you the moving average a second ago, and how, actually I'll show it to you again real quick because it'll be interesting. So you can see how the market went below water, below the 200-day moving average here for, it looks like probably about 1, 2, 3, 4, 5, 6, 7 days, 8 days, something like that. But when you look at the VWAP, the average price paid on the market, it actually, not only from the market bottom, the VWAP from the bottom, but the VWAP from the top, not only converged, but the market bounced right off that VWAP. In other words, market participants the psychology here is, market participants may have been thinking, well, I'm willing to wait until the market gets down to where I'm at break even, and if it goes below that level and I start to turn a loss, I'm going to sell. But there may have been market participants looking out there and saying, look, as soon as we hit that level in the sand, we think people are going to start buying. So buyers came in, and you can see here those 3 big hollow candles. Those are big up days, 3 in a row right there, and then a couple gaps. And so it's just really interesting, and this is where the market is not exactly efficient, is it? The market acts in very mysterious ways. And then on top of that, I threw RSI, so momentum indicator down here in the bottom pane. RSI barely, if you want to split hairs, barely got below 30, but really never got decisively oversold, and has been very clearly and decisively overbought several times here over the course of the last year. So this just points to me that the market is looking very healthy right now. Changing gears, we're looking at the small cap stocks. So I always look at the Dow and the S&P 500 and even the NASDAQ. Those are like the generals. And then the small caps, like the Russell 2000 here, is the troops. So when the generals, the big, huge mega cap and big cap stocks, when they go into battle, it's really important to have the troops behind them. If they're running into battle and they turn around and all the troops are back in the woods, that's going to be a problem. The market cannot survive long term without the troops going to battle and running up the uptrend as well. We need market participation. We need broad participation. We can't have a very thin number of stocks driving the market for very long before eventually things will just kind of roll over and fall south. So I've been really paying close attention to small cap shares here. In fact, during this time period, very short time period here, we went pretty heavy into small cap stocks with the line in the sand being the breakout. As soon as it fell back below that line in the sand, we were back out of small caps again. So I'm just kind of sitting tight here right now, waiting for an opportunity for this thing to break back out again, which I imagine if it did, it would probably hold this second time around. But again, we can't have opinions. We certainly can't trade on opinions. Market doesn't care what we think. So got to have your rules and stick to them. And then on the downside here, not that I think this is going to happen, because I really don't think that we're going to see the market or small caps break south of this level line in the sand. But you can see that there's a point of potential support, or a floor of support down here at the lows represented back in 2022 twice, and then in the fourth quarter of 2023. So again, paying really close attention to small caps, because these are the troops. And while the generals continue to do well, and I have more statistics and more things to show you later about the health of the market, but we need to have these troops go into battle as well and join the generals, and to see more smaller and mid-cap stocks participating in the uptrend. So I think that's probably what's going to happen here, but we just have to wait and see. When we look at our RG chart, this is a relative rotation graph. So the upper left-hand quadrant is improving versus the market. Upper right is leading versus the market. Bottom right is weakening versus the market. And then bottom left is lagging versus the market. And the market is the 0 point right here in the XY axis. So you can see here the energy has really been lagging. And really, not only has it been lagging, it's been lagging a lot very recently. So we've got utilities and staples, both of which look like they were starting to improve, but then they curled back down and jackknifed back toward the lagging quadrant, and that's good. And the reason that's good is because staples utilities, are defensive stocks, and if we have defensive stocks weakening, and then we have offensive stocks doing well, like information technology over here, so tech, financials, even communication, if those type of stocks are doing well, then that's good for the market. So, we always want to look at things from the weight of the evidence. There's no one light switch that if you turn it on, then the market's great, and you turn it off, and things aren't great. It's kind of a conglomeration of a bunch of different clues and evidence, and you put it all together, nothing's almost ever going to be 100% great or 0% bad. So let's look here at, speaking of discretionaries and staples, this is a relative strength chart. So when the chart is going up, that means staples are doing better than discretionaries, and when the chart is going down, that means discretionaries are doing better than staples. Well, what are staples and discretionaries? Well, staples are the things we need in our lives, things like milk and food at the grocery store, and razors to shave with, and all the things that we need to use on a day-to-day basis. Discretionaries are more wants or luxury items. So the reason why this chart's important is because when it's going up, in the case of staples being in the numerator here, if it's going up, that means people are more interested in buying stocks, or in other words, stocks are doing better that happen to be in the needs category. Or said another way, wants, luxury items aren't doing so well because people just aren't spending money on them. They're weakening, or at least lagging versus staples. However, when this is going down, what that tells us is that the wants and the luxury items are people spending money. They care. That doesn't mean the staples are going down, by the way, on an absolute basis. This just means on a relative basis that discretionaries, luxury goods, things that we want in life, are doing well relative to staples, which is good for the market, right? A couple of individual stocks that have been getting a lot of news lately. First is Novo Nordisk, and the second is Eli Lilly. I'll show you both here really quickly. These are the companies that are broadly making drugs from the generic form of semaglutide, which you may know them as Wegovy, Rybelsus, and Ozempic. Last summer, early summer, I believe it was, the FDA approved this diabetes drug as a weight loss drug. And since that happened, for years, decades, right? People have been looking for a magic pill that will help them lose weight. Well, Rybelsus is the pill, and unless you want injections once a week, and that would be your Ozempic and Wegovy, I believe it is. So these three stocks are doing really, really well. I'm sorry, three stocks. These two stocks are doing really well. These three drugs are obviously selling off the shelves, and I know that Novo Nordisk at one point said a little bit earlier in 2023 that they were going to have to stop selling it, or allowing people to buy it who did not have diabetes, because they just don't have enough to go around. So good-looking stocks, as is Eli Lilly, and as long as nothing changes in the world of health and healthcare with the momentum of these drugs, I think that these stocks could be ones to pay really close attention to. The value line geometric index basically looks at the average stock in the market, so it looks like it's basically the average stock, price of the average stock. And this is a really, really long-term chart going back to the late 90s. And you can see this line in the sand that I've been watching. And last year when we did this report, we were right here, which is kind of funny, actually. So I think that's a pretty important line. We got a lot of polarity here, where back in 1998 it stopped and went down. Average stock peaked in 2000. 2007 and then headed down during the mortgage crisis. It peaked again in 2015 and headed down, and then it broke out. And then it was just a total mess, pretty much between we'll call it, well, you could say the mess started in 2015, really, but if you look at this line in the sand here and just how it didn't care about it at all, it just, things got really, really messy between 2018, 19. You had COVID, but now it's starting to act a little bit more orderly. It keeps hitting this line and bouncing back above it, and that's what we want to see. Is we want to see the average stock doing better, and we'd like to see this line in the sand hold. And really, most recently, you can see 1, 2, 3, 4 tops here. We'd like to see a breakout above that level too. I probably should have thrown a line of ceiling and potential resistance there as well. And then one thing to share, I mentioned earlier that there's not a whole lot to say about international stocks. One thing I wanted to share is another relative comparison chart, so a relative strength chart. And last time we did staples versus discretionaries, or needs versus wants. This one is a relative strength chart comparing U.S. stocks to international stocks. So when it's going up, U.S. stocks are better to own. When it's going down, international stocks are better to own. And you can see at the very end of 2022 into the beginning, call it first quarter and a little bit more of 2023, we'll call it the first half of 2023, international stocks were looking really, really good as a whole. And it was looking like maybe for the first time since the mortgage crisis, so for the first time in 15 plus years, we could actually start to see international stocks outpace U.S. stocks. Or said another way, it was starting to look like U.S. wasn't going to be the best stock market in the world for the first time in 15 years, which is what it's been. And it's pretty amazing, really. And instead, what we saw was we've seen both U.S. and international did really, really well, but on a relative basis, we kind of saw it kind of chop sideways here the second half of the year. And then most recently, just actually this month, things have really started to break out in terms of U.S. stocks being the true leader. On a relative basis, international stocks are starting to fall more and more behind. And then a lot of that also is being made even worse or better, whatever, depending on how you want to look at it, because of the U.S. dollar. The U.S. dollar is getting really, really strong and is breaking out as well. So I'm not going to talk any more about international stocks today. In fact, we were pretty heavy in the international stock market through about mid last year. We lightened up quite a bit in summer, and at this point, we're probably going to be exiting the U.S. markets. The international markets altogether at this point. If we own any international stocks, it'll be individual stocks or individual positions that are surgically chosen because they're leaders. All right, let's talk about bonds and fixed income for a little bit. Not a whole lot to say here. Like I said earlier, I already showed you the drawdowns in bonds, which have been terrible. And that's just the AGG. That's just the average bond. What you're looking at here is the 20-year Treasury bond. This is U.S. Treasuries, 20-year U.S. Treasury bonds. When you look at 2023 into the beginning of this year, so I went back to 2023 to present, Treasury bonds, 20-year Treasuries are down about almost 9%. But when you look back to the peak, which took place in 2020, after COVID, they're still down 45%, more than 45%. And currently they're in the midst of a pullback, which could turn into a correction, but we'll see what happens here. I'm kind of eyeballing, if you can follow my mouse right here, I'm eyeballing these lows from back in the fourth quarter of 2022 as a place where this current pullback could hold. And if we got a higher low, that might be a really good place to basically jump in and start participating in bonds with a line in the sand being at that point of entry, that higher low. But again, bonds, be careful, my good people, my friends. Be careful. Don't just blindly have your portfolio diversified in stocks and bonds anymore. And that hasn't been the case for a couple years now, almost 3 years at this point. And I just think that you got to be really, really careful. It's not like the old days where, interest rates went down from, back when people were paying 16% on their mortgages in the 80s, and as rates went down and down and down, and then you had Yellen and Bernanke, and then it had you just had these sinking rates to the point where they were literally at zero for the longest time. I mean, they even gave it an acronym, ZIRP, zero interest rate policy. So just be careful with bonds. That's all I'll say, and I'll just shut up. This is another chart, same chart, by the way, same 20-year Treasury chart. I forgot that I did draw that line in the sand, so sorry about that. I'm forgetting what I did just literally hours ago as I built this chart, this slide deck. I thought this was really interesting. So last year in January, when I did this market outlook, this is what the RRG looked like, the relative rotation graph. We had zero coupon bonds, so 30-year zeros, and 20-year treasuries here, TLT. These are the bonds, by the way. We had them in the improving quadrant, kind of heading toward the leading quadrant, which would insinuate health, right? That things are getting better. Might even be a good entry point, a good back here. When it was coming out of the lagging quadrant pointing northeast, might have been a great place to get in if you felt really confident. Now, I wouldn't do that because I like personally buying off higher lows. If there's no higher low, if it's just a low, then, I mean, in my opinion, it's just more gambling and guessing than anything. So I'm looking for a trend to take place, which means I'm never going to buy at the bottom, and I'm also never going to sell at the top, by the way. That's just that's impossible. Well, unless you get lucky. I guess it's possible if you get lucky. But anyway, so zeros and 20-year treasuries are moving into the leading quadrant up here back in January of 2023, and you had short 20-year treasuries, 10-year treasuries, so shorting the bond market in the weakening quadrant heading into the lagging quadrant. And we know what happened. We know now, going back, I'll pull up the chart, we know now that in 2023, instead, this was when things were improving, instead it just kind of chopped sideways and then headed down again. Well, what's it look like right now? Again, this is 2023. You're barely going to be able to tell the difference. Here's 2024. Ready? 3, 2, 1. Looks almost exactly the same. You even have corporate bonds in the same relative place. PCY is almost in the same place. You got zeros up here declining into the leading quadrant, but declining, pointing southeast. You've got short bonds, short 20s and 10s in the lagging quadrant. So I don't know what's going to happen. I'm not a trend predictor. I'm a trend follower. So right now, all I'm saying is that be really careful with those bonds. And I think I've said it enough, so I'll shut up. I guess I lied last time. I didn't shut up. All right, let's change gears, talk about some alts. The first is Bitcoin. I know this is a little bit messy chart. I like to use TradingView for my Bitcoin charts because they have so many ways to look at this. So it's good charting software. And it's free, by the way. I think there's a free subscription anyway. But anyway, you can see going back to 2018, here's the highs. We draw a line in the sand over here. You can see it bounced right off those highs of 2018 and 2023. So fourth quarter, call it December of 2022, bounces off that line in the sand, heads northward. The next line in the sand we have here are the summer lows from 2021. You draw a line from those summer lows across. You can see how it bounced, and I'll say hit its head on that ceiling twice here in summer of 2023, and then found itself breaking out above that level and then hitting its head right here on this point of potential resistance. So right now, it would not be surprising at all to see Bitcoin at best chop sideways, at worst start to pull back and consolidate or correct toward that previous line of resistance, which would now act as potential support. And when it breaks out, I shouldn't say when. That was terrible. I broke one of my own rules. You never say when. I have no idea, obviously, when this is going to break out or if it'll break out. So I said it again. I said when again. So if this breaks out above this line in the sand, the next clear line in the sand would obviously be the all-time highs here. I mean, this is probably within 4% or so, maybe 5%, the two highs here. So that's what we're looking at with Bitcoin. A lot of ETFs just came out. And, of course, prices pulling back. I think it's down like 10%, 14% or something like that, right as soon as the new ETFs hit the market. That's what the market does. It disappoints the highest number of people at the most inopportune times. All right, let's look at gold. Poor gold. This gold chart goes all the way back to 2020, after COVID. And you can see here the gold hits a high right around $2060 or so, $2,060. And then it just kind of goes down, pulls back, creates another base. This base seems like it's going to resolve itself in early 2022. Hits that same ceiling of resistance, pulls back, I'm sure that the gold bulls are thinking, hopefully this is maybe a big cup with handle pattern, but nope. It breaks out of that handle and then just tanks. I mean, just back down again. Not only back down again, but you could draw a line with your eyes right here going back to the fourth quarter lows of 2021, and here we are in summer of 2022, and it tries to hold that line in the sand and just cracks below it. More lower lows, lower highs. Starts to find some traction, or late 2022 into 2023, taps that ceiling again twice, 2 times, pulls back again. And then it heads up, breaks out for a day, pulls back. Tries to break out for several days here, 1, 2, 3, 4, 5, probably 6 days there, I think, maybe 5 days. And it's back below that breakout again. And something else that I noticed as I was pulling up the chart, first I just pulled up the chart, the price alone, that was it, so just the upper chart here. But I was just curious what momentum looked like. And sure enough, we see lower highs of momentum with higher highs in price. And what that is, that's called a negative divergence. And what that means is momentum is negatively diverging versus price, which usually indicates that there's a possibility, or at least an edge here, or higher chance that price goes down and follows momentum. Now, it doesn't happen every time. It's not 100% win rate by any stretch of the imagination, but it's definitely a warning sign. So it would not be surprising at all for me if I were to see gold pull back here and start heading back toward this low. Maybe even back down here again, but we'll have to see what happens. I mean, it could also completely violate this downtrend line right here. So if you extended this arrow down, it could also break out above this that descending trend line, and then break out above 70 again, end up in bullish RSI or bullish momentum territory, and break out in price as well. So again, we'll just have to see. But right now, it just looks like it's continuing to contend with that ceiling of resistance there that is just really struggling to break north of. Next, we'll look at oil. Oil prices going. You can see 2022 here. Oil prices went up really high. I'm not sure what the price is here. It looks like around 123, 125-ish. I'm just taking a guess. Just drawing my eyes to the right over here. But then it kind of headed down. So from summer of 2022 to where we sit today, there was kind of a temporary spike this past summer, 2023, up into the 90s. But oil's trading right around $73 per barrel. And there's this potential floor of resistance sitting below our feet, right around $67 a barrel or so. So it's going to be interesting to see what happens here. But obviously, one of the reasons why energy has been weakening, energy stocks, is because of oil declining in value. And then speaking of probabilities, by the way, this is a seasonality chart for oil. I'm trying to think. This is Ned Davis Research that pulled this up. So I can't remember who I got this from, so I apologize. I borrowed it from somebody here, but don't know who it was. But anyway, you can see here the first quarter of the year tends to be pretty flat for oil, seasonally speaking. And then from April all the way through the third quarter tends to be good. In other words, positive price movement for oil. The fourth quarter tends to be bad, which is what we've just been through. So if you're an oil owner or you're looking to buy oil, this is some evidence that you can use at to your advantage, perhaps, along with some other analysis, looking at the chart and so on. All right, let's look at some intermarket analysis, some indicators, some other things that give us some more evidence and hints of what's going on in the market. This is from Ryan Dietrich, fellow CMT and analyst. The Santa Claus rally. Santa Claus rally is the last 5 days of the year and the first 2 days of the new trading year. And the saying goes, this is Yale Hirsch, who invented the Stock Traders Almanac, and now Jeff Hirsch, he runs it now, has been running it very well for many, many years now. But the saying is, if Santa should fail to call, then bears may come to Broad and Wall. Broad Street and Wall Street, obviously, is where the New York Stock Exchange is. So it's saying that if the Santa Claus rally fails, in other words, if it's down, then it's a potential negative sign or negative omen that the stock market may not do well the next year. And this year, I'll show it to you in a second here, but this year it was not positive. You can see Santa comes to town. Santa Claus rally was down. And then you can see here, these are the years where the January barometer, so the month of January was down as well, with the exception of 1993. And then you can kind of see how the first quarter went and the full calendar year. So you've got A couple negative numbers here, down 1.5, down 10.1, up 3, down obviously 2007, that was the mortgage crisis, down 38.5%, about even for the year in 2014, and then 2015 was positive. But here's the data directly from the horse's mouth. This is directly from Jeff Hirsch at Stock Traders Almanac. And this up top here, this is saying if we have a Santa Claus rally that's down, and then the second indicator is called the first 5 days. So remember, the Santa Claus rally is the last 5 days of the year and the first 2. And then the second indicator in this seasonal table that we look at is the first 5 days of the year, and then the third is called the January barometer. It's basically the performance of the month of January. Another saying, it says, as the January goes, so goes the year. And so what we're looking at is for these three things, in a perfect world, for the January barometer to be positive. That's what we would want. But you can see here that in the past, when you've had a time when the Santa Claus rally was down, first 5 days were down, but the January barometer was up, in other words, the month of January was up, then you can see February was decent, average up 3%, but the last 11 months of the year averaged 15%, going back to 1985. However, when the Santa Claus rally is down, the first 5 days are down, and the month of January is down, you can see here, looking back at those times, and you look at the full year, that we kind of have a hodgepodge here. The average is down 3.6%, with one nasty year in there being the mortgage crisis, but up 2.6, down 11.4, up 1, up 15, we'll call it, up 3, up 9.5. So definitely not as convincing, I guess. Not a huge sample size here, but definitely something to kind of keep paying attention to as time goes on. So, and by the way, the last 11 months, having nothing to do with the month of January, the last 11 months is right around even. You can see down here, 0.2%. This is the average seasonal monthly return going back to 1928 for the S&P 500. So what we're looking at here is basically the average monthly return. You can see here is 0.6% per month. But you can see how the month of January is typically a pretty good month, and the median is higher. You can see that February is usually a very, very shallow but negative month. You can see March, April, positive, May, down, June, July, and August tend to be good, but September's horrid. It's the worst month of the year on average. And then the fourth quarter tends to be pretty good. So that's kind of what we're looking at in terms of averages going across the board to every year and every month going back to 1928. And then you get people like at Finamize. I found this, and I want to be objective, and I know a lot of the things I've been saying have been very bullish or very positive. And so I want to throw something in here that's a little bit negative, an indicator that's negative. You can see down here the blue is the average investor's stock allocation. So it's the percentage of stocks owned. And you can see when it hits these higher levels here, it's inverted, that you tend to see tops in secular markets. So what this is generally saying is at times in the past when they've reached similar levels, the market has reached a point where it's gone from a secular, or in other words, a really long-term, call it 10 to 15-year bull market, to a period where maybe 10 years goes by, or longer for that matter, 14, 15, of a secular bear market, where it's not down the whole time, it's just kind of sideways, up and down, but sideways for a long time. You can see the same thing here between 2000 and I believe this would probably be 2013. Probably 2012, actually. Kind of hard to see. But anyway, so we're at that level right now. So, what's that mean? Does that mean that go run for the fences, sell everything? No. This is a really long-term chart. This goes back 50 years. So we'll just have to see what happens. Back in 1998, there was a point at which the market looked like it was going to really, really struggle. Market was down, I believe, 19% that year at one point, and then all of a sudden it headed higher for the next year and a half to 2 years, and it did so in a very big way. And if you just sold because you got nervous because of one indicator, then you missed out on a lot of returns as a result. All right, a few charts here that are going to look similar, but the top pane's the same. And every one of these next, it looks like 5 charts. Yeah, 5 charts. So we're looking at the S&P 500 in the top pane, and then the bottom pane is a breadth indicator. So not breath, not the smell of your breath, breadth. So different ways to measure participation in the market. So the first one we're looking at here is the percentage of stocks above the 50-day moving average. So we're, again, S&P's in the top pane. This is showing us or answering the question, what percentage of stocks in the S&P 500, so think again, generals and troops, so of the 503, I think it is, 503 stocks in the S&P 500, what percentage of those stocks are above their 50-day trend line or 50-day moving average? And you can see here it got as high as 90%, and right now it's sitting around 74%. But you can see this has been improving. That's good. The next one we're looking at here is the percentage of stocks above the 200-day moving average. So a much longer term indicator. And what we're seeing here is 69% of stocks are trading above their 200-day moving average. I like when they're above 50, but definitely above 60 is good. So lots of stocks trading above their 50-day moving average. This one's a little bit nerdy, but what we're looking at, remember that momentum indicator I was showing you? In fact, I'll go back and pull that up real quick here. So it looks like we were looking at gold. So this is RSI. It's a momentum indicator. When it's above 70, or I should say if it's between 30 and 100, that's considered to be in a bullish regime or a bullish area. And what we want when a stock or an index or a sector is looking really, really good from a momentum standpoint, it tends to bounce off that 30 level but stay above 30 and then sometimes spike above 70 from time to time. When things aren't going so well, you'll see it hit a ceiling up here at 70 and then spend time peaking below or dropping below 30 instead. So in other words, 70 is a good number, and if we're above that number, that's good. If I go back to the indicator here, what we're looking at is the percentage of stocks that have an RSI 14 or 14-period RSI number above 70. And you can see here recently, and this speaks to the divergences, by the way, recently this was up as much as about 45, 46%. That's good. Really good. Now it's come back to about 10% recently because the market, even though it's going higher, we're seeing stocks within the market pulling back, which is, again, a negative divergence. So something to pay attention to here and something that I would definitely put in the negative evidence category, but only on a short-term basis. I don't think that that this is giving us any signs that the market's going to crash this year or anything even remotely like that. So this more tells us that as the market's been going up and breaking out to new all-time highs, again, it would not be surprising to see a pullback, consolidation, or even a correction over the course of the next couple months as we close in on summer. Last two I have for you here in this breadth category or participation category, or the percentage or the number of stocks, percentage of stocks hitting 12-month highs. So this is the percentage of stocks within the S&P 500 that are hitting 1-year highs, 52-week highs. 59%, almost 60%. That's good. Again, very positive for the market. And then this is the percentage of stocks that are within 20% of hitting a 52-week high or 12-month high, which that, as you can see here again, is rising. We go back to what it looked like. Going down here, we have a high and then a higher high, and then we can see here lower highs, lower lows, lower highs, lower lows. I mean, the percentage of stocks within 20% of their 12-month highs are just getting worse and worse and worse. What we wanted to see here, you can see how this low here, right there, was this is the same low, roughly speaking, and you can see how this is a lower low, so that was a positive divergence. It was a hint that maybe the market was starting to bottom out. Now it's a maybe, right? You can't just, again, it's not an on-off switch, it's a dimmer switch. We have to look at lots of evidence. Nobody could have just said without seeing the rest of this chart that because we have a positive divergence here and more stocks are starting to participate while price is going down, printing lower lows, nobody could look at that and go, I'm going to go all in. I mean, they could technically, obviously, but I don't know that would be the best idea. Now, in hindsight, it worked out, but it doesn't always work out that way. Right now, we have 78% of stocks within 20% of their all-time highs, or not all-time highs, but 12-month highs, and it's been as high as, looks like 82, 83%, so that's good as well. Now let's talk about next year, kind of look ahead. The first thing I wanted to start with is the fact, again, just more expectation setting. It's really important. I know there's lots of investors out there who have been sitting on their hands. They've been waiting for things to get better, and they're probably pretty frustrated right now. Unfortunately, there's this thing called confirmation bias, where if you're not in the market, or if you've been really, really conservative, or if you've been waiting for the perfect time to get into the market, you're looking for research that supports your opinion. And so the reason I say a lot of the bearish people, a lot of the people who are negative on the market are pretty pissed off right now is because the market's actually done pretty well. I mean, with the exception of those two little corrections, which at the time they felt rough, but the correction that took place in March of last year and the one that took place from January through October, I mean, the market's done well otherwise. And it looks like it's continuing to do well. So the people who are bearish, the people who are just looking for research that says things are going to get worse, you're not helping yourself. You need to be objective, and you need to realize, first of all, the market has a positive bias. That's the first thing. And the second thing here is all these little diamonds are the intra-year drop of the market. And now some years the market's down big. The market ends down big, but other years, most years I should say, the market ends up. But during that year, like we look at this right here, market's up 10%, but it went down 16% that year. 16%. So just because if you would have just freaked yourself out and allowed yourself to just sell everything and wait for a better day, now you're sitting here looking at 2011, looking for a better day, which, by the way, the market was down as much as 19% during 2011, and it ends up being down for the year. So now what do you do? So it's really important, again, to be systematic, to be robotic. Don't look for research that supports your opinion. Be objective. And like I mentioned earlier, I think that's one of the reasons why we have a job, I guess. But here's another one. The months of November and December were good in 2023. So really, really good November, December return. And when you look back at years 1954, 62, 70, 85, 98, and 20, when you look at times when the market has done really well the last 2 months of the year, you can see, you can see that generally speaking, the longer you go out, you get really good numbers. So first quarter up an average 6.6%, and the average the following year was up 19.5%. Does that mean we're going to have a 20% return in 2024? No. Could we? Yes. Could it be higher? Yes. Could it be lower? Of course. We're also in an election year, and election years don't tend to be the best year for the election cycle. So it wouldn't be surprising to me to see a single-digit year. I would assume that the market would probably be up this year. There's no president in history who doesn't want the market to go up when he's trying to get reelected or she's trying to get reelected. So that's a good segue, because now let's talk about seasonality from the standpoint of an election year. You can see here the black line is all election years. It's the average return, kind of goes sideways for most of the first half of the year with just some dips in here, and then the second half of the year tends to be good. When you look at a sitting president running for re-election, that's this line here, you can see the market usually goes up the first month and a half, pulls back to even again, and then does well through the remainder of the year on average. And then open field simply means that it's after a second term, or the market, basically we're looking at two new presidential candidates running. So that's what open field means. And during an open field, you tend to see a pretty rough market for the first half of the year, breaking even right around halfway through the year, and then choppiness sideways, and then kind of a negative end of the year. So that's the numbers. This is the same thing with the NASDAQ. So I won't go through it one by one, but just generally speaking, all election years tend to be up, again, kind of flat for the first half of the year, then up the second half of the year. And when we have a sitting president running for re-election, it tends to go up the first month and a half, down, break the even, and then does well through the second half of the year. A little nastier for the NASDAQ when there's an open field, but that's not the case. At least right now it's not. So I'm not really too worried about it yet. Next one, this is just simplifying things here. This is simplifying all election years going back to 1950. Again, you can see market tends to be flat for at least the first quarter, even down a little bit on average. And then come April, it tends to find some traction and decline between September, October, November, and then head higher the last 2 months of the year. And then Lowry Research. So Lowry Research is, I believe, the oldest technical analysis research company in the country. I've been a subscriber for a long time. They're wonderful. And I normally don't repost their research because, I don't know that they like it when I do this. But I'm plugging them here like crazy, so hopefully they'll be okay with it. But what we're looking at here is the NYSE Momentum Indicator. So it's the percentage of Lowry's operating companies only So in other words, on the NYSE, it's just taking out all the bonds and things like that. So operating companies above their 30-day moving average. And you can see here it's at 90.35% as of the market close on Friday, January 19th. And there's only been 17 times since 1990 that this indicator of the percentage of stocks on the NYSE going from below 15% to above 90% in one sweep, only 17 times. This is the 17th time that that's happened. And in the past, it's got a 100% win rate, this indicator. So that's the first thing. So first thing is when that's happened before, when the percentage of stocks above their 30-day moving average have gone from below 15% to above 90% of stocks above their 30-day moving average. Every time that's happened since 1980, the market has been up 12 months later. That's the first thing. Second thing is the median return is 16.5% and the average is 18.7%. The third thing is the mean or average is higher than the median, which what that means is there's a positive skew. So since the average is higher, that's even more positive. So again, that doesn't mean that this can't be the first year that it's negative, of course, 12 months from now. And it can't be the first year that we see a really putrid number. But when you look here, I mean, the worst number is 4.27%, then 5.2%. It looks like 4.9 here in 2022. But I mean, these are pretty good numbers. The indicator has a pretty good track record. All right, let's slow down and back up, zoom out. This is, I didn't label it, I apologize, but this is a long-term asset class ranking. I show this every time we do a quarterly scouting report, market outlook, or halftime update. What we're looking at is just a long-term relative comparison. In other words, a relative strength chart comparing all the big asset classes. So this is S&P 500, so large cap stocks in the lead right now, and that's been the case for a while here. Going back for a while. Number 2 is international. Like I mentioned earlier, we're starting to see it diverge. We're starting to see international really lose ground relative to the U.S. stocks. Small caps really started to do well here and surpass T-bills, and now they're pulling back, and we'll have to see what happens. If you remember the IWM chart that I showed you earlier, that's what I'm looking at here. This is going to be really crucial for the market to continue doing well, and for this trend to continue northward is for small cap stocks, in other words, the troops, to participate in this battle. Then we have fourth place are just money market T-bills, 1 to 3 month T-bills. Fifth place, barely, is commodities as an index. So that's everything from energy commodities like oil, natural gas, gasoline, to precious metals like gold, silver, to other metals like palladium, platinum, soft commodities like wheat, corn, cotton, soybeans, and so on. So you look at the whole basket, commodities as a whole in the basement, but barely second from last. And the last place again this year, I think now for the third year in a row, is bonds. So 20-year treasuries in the basement as the last place winner again, unfortunately. Or last place loser, not winner. Or winner of last place? Is that something to be proud of? All right. Something that people really seem to like, not only our clients, but people in social media seem to really like this chart. So I tend to make a habit of recreating it almost every month. So this is my inverse traffic light of the S&P 500. So when we look at the stock market, I'm looking at lines in the sand like this high here. This was a bull trap. Here's another high here. Tried to get above this here and kind of went sideways and then broke out. So that's where I get my little caution area here. Is I'm looking at support and resistance levels basically. So below these lows, the October lows would be red zone for me right now. That'd be no touch. That'd be like things are not going well in the market. Caution, but not negative, but caution is going to be anywhere between the highs from spring of 2022 and the highs of summer of 2023. And anything above that to me is the green zone. So right now, green is good, breaking out to all-time highs. Market looks great. And if it were to pull back to this yellow zone, which it would not surprise me if it did, by the way, again, this is our floor right here of potential support. It would not surprise with that divergence I was showing you earlier for the market to pull back to that line, maybe consolidate sideways. That would be even better if it just consolidated sideways and just kind of chopped up and digested the gains before heading higher. But what we don't want to see is for it to crack below these two highs and break down into the caution zone. But even if it did, it wouldn't be a huge deal. We'd be looking at this level here down to the bottom of the yellow zone as kind of a drop dead area, at which point the market would officially be in a downtrend and we'd be back in a bear market again, in my opinion. And so the quote I told you I'd finish with, John Templeton, portfolio manager, former portfolio manager, I should say. And this is a really good quote. Bull markets. So bull markets are good markets, bear markets are bad markets, right? And if you haven't heard me say this before, and if you don't know, the reason they call them bull markets is because bulls attack with their horns from the bottom up. They're good markets, up markets, and bears attack with their claws from the top down. So that's why they're called bull and bear markets. So now that you know that, this quote should make sense. So bull markets are born on pessimism, they grow on skepticism, mature on optimism, and they die on euphoria. And the first person that showed me this quote was Mark Zinder, actually. Mark Zinder is like me, loves quotes, but he's got a bigger collection than I do. But Mark was one of my earliest mentors, and when you look at this quote, I remember him explaining it way back when and how it worked. This was back in like 2005. So bull markets are born on pessimism. That means that when people are pessimistic, that's when the bull market starts. They start to grow. So the bull market, the bottom of the market was in October of 2022. Market starts doing better, pulls back in March of 2023. We're finally in an uptrend in, we'll call it March, April of 2023. So the market's been growing since then, but it's growing on skepticism, isn't it? So people are still skeptical. There's still lots of bears out there that are saying this thing is not going to last. The market's going to crash again, blah, blah, blah. And as this market continues going up, if it continues going up, I should say, it's going to mature, more than likely, on optimism once most of the skeptics have decided, okay, maybe this thing's for real. And then eventually someday, once everybody jumps on the bull pile and everybody's in the bull camp and everybody thinks things are going well, that's when it will die. And that's how markets work, unfortunately. All right. So with that all being said, here's our contact information if you'd like a second opinion on your portfolio, your retirement plan. If you're a business owner and you would like to discuss business transition planning, increasing your profits, increasing efficiency, decreasing the amount of time that's required of you in the business, increasing the value of your company, your multiple. If you are a individual, a couple looking for some sort of financial sense, to figure out when can I retire when I want to, when can I make work optional, have I done enough, what do I need to do, what do I need to change. That's what we do here. If you'd like a second opinion on your portfolio, of course, I think I just said that, but please feel free to reach out to us as well. I love talking about the market, in case you can't tell. But you can find us on Instagram. You can find us on Facebook, LinkedIn, X now. It's not Twitter anymore. It's called X. I'm just having a hard time calling it that. But again, there's our contact information. I already mentioned earlier that this video was recorded Saturday, January 20th. A lot of the materials were picked out between December and the market closed yesterday, January 19th. So there's the disclosure there. And then here we'll finish on this big, huge page of fine print. So thank you so much for watching or listening. And if you have any questions at all, please, by all means, give me a call, shoot me an email, shoot us a message online through our website. Would love to chat. Otherwise, I hope you're having a great start to the year, and we'll hope to talk to you soon.